Hi, it's Nova here with Travere Financial. We're a financial service company based out of Fairfield, California. However, we operate all within the United States. Today, we're going to go over buying a home. There's two strategies. We can use traditional method, which is taking out a mortgage loan, or the second method, which is borrowing from your IUL policy. Now, my question to you is, which strategy builds wealth the fastest? Now, let's talk about the two candidates we have today. First candidate is Max, and second candidate is Sam. Let's talk about the common grounds between these two. Both are 36 of age. Both live in California. They both make $150,000 per year, and they both want to buy a home for $475,000 approximately. Now, let's talk about the difference between the two. Max is going to use an IUL, while Sam takes the traditional method of a mortgage loan. Now, let's go over Sam. Look at Sam here. He looks very depressed. And I'm going to tell you why he's depressed. Sam takes a traditional mortgage, which means he decided to take a loan from the bank. Yes, he may have a zero down payment because he was approved for the $475K loan. However, that loan is going to be at a 7% interest, meaning that he's going to pay a high interest on top. His monthly payments that he has to make is approximately $3,000. On top of that, the interest in total that he has to pay after paying off the home will approximately be $187,000. The downside to this is Sam is locked in on his payments, meaning that he has no option but to pay every month. He has a high interest, meaning he's going to pay a lot more extra money on top of what he took out for the loan, and he has no flexibility. Now let's talk about Max here. Look at Max. You see this smile? That man is very happy. And I'm going to tell you why Max is so happy. Max decided to buy his home with an IUL. He has an IUL policy. He's about 15, 16 years in. He pays approximately about $1,500 a month into the policy. His cash value is already grown to $528,000, which is more than enough to buy a home for approximately $475,000. So what did Max do? Max took out a loan from himself for $475,000 tax-free, meaning that he's not paying any taxes on this method while he's borrowing. He buys his house. Now that he buys his house, he has no down payment because he just approximately borrowed $475,000. On top of that, he may have borrowed his money, but the growth still continued. Now you may be asking, how does your growth continue when you borrow $475,000 from yourself out of that $528,000 that you have within your cash value? I'll tell you how. It's real simple. Yes, he may have borrowed $475,000 from himself. Yes, he borrowed it at a 5% interest rate. However, his policy makes about 10% back a year, canceling out that interest rate. And the value of that policy does not lose its value once it's borrowed, meaning that yes, he may borrow $475,000, but the value still grows every year. Now, the upside to that strategy, Max has no required payments, meaning that he doesn't have to pay every month. He can pay once a year, once every 6 months, or once every 3 months, or if he chooses, he can pay once a month. That leaves him with flexibility. That's the benefit. Now, final comparison so we can compare the two and wrap this up. Max used the IUL, Sam used traditional mortgage. Now let's go over this. Max decided to own his home outright by borrowing that $475,000 from himself, tax-free. Sam decided to borrow the money from the bank, tax-free. However, he has to pay the bank 30 years back of worth that money. And if he faults on any one of them payments where he can't pay it back, the house may not be his for much longer. On the other side, Max takes his time, pay himself off. He already owns the home. Zero interest. We went over the zero interest part, but to refresh your memory, Max policy earns about 10% a year. He borrowed from himself at a 5% interest. Put them together, they cancel out. He has zero interest. While Sam, he took out that traditional mortgage loan, he does have an interest. Remember, he's paying 7%. And approximately with 7%, he's going to pay at least $187,000 in interest. cash growing. Like I said before, he borrowed from his policy. Since Max borrowed from his policy, he never lost value within the money that he has within the policy, meaning that his cash value grows once a year, and it's going to keep growing forever, as long as he doesn't fault on his contract. On the other side, Sam money is locked in his equity, meaning that he has no cash value growing because it's locked in. Flexible terms. Remember, Max doesn't have to pay back once a month. He can pay back once a month, once every 3 months, once every 6 months, or once a year, whatever he chooses. While Sam, he doesn't have that option. He has to pay back every month. And if he doesn't, that's a hit to his credit score, and that could put a lien on his house. Build wealth. With the IUL, Max is actually building wealth within his IUL policy because the cash value still grows, meaning that he doesn't lose value within his policy even if he borrows from it. While Sam, on the other hand, just collected more debt. So my question to you is, which one do you think is the better choice of buying a home? See this face right here? That's a happy face. You know why? He chose the smart route, which is the IUL. You borrow from yourself where there's no banks needed. No mandatory payments. You're flexible in paying whenever you want. The cash value keeps growing instead of you building more debt and your money's locked in. You build wealth and not just debt. That was today's method of going over how to buy a home using a traditional method or using IUL. See you soon.